Welcome to the Valmika Property Investing Podcast, where I, your host, share the key to success in the Australian property investing market. I'm the founder of Valmika Buyers Agency. You can find us at valmikaproperty.com. The contents of this podcast are the personal opinion of your host and are intended for entertainment purposes only. Any financial advice must be obtained from your trusted financial advisor or a qualified professional. In this week's episode, the topic is positive versus negative cash flow properties. I'll start off by giving you an overview of what makes cash flow positive or cash flow negative properties from a economics dynamic on how it works. Then I'll move on to section 2, where we'll discuss choosing a strategy. Here we'll go through the pros and cons of positive and negative cash flow properties. Then lastly, we'll discuss portfolio enhancements and how we balance growth and yield by using these two strategies. But before we go into this week's topic, let's discuss the auction clearance results for the week ending 13th of August 2023. Starting off with New South Wales, another strong clearance of 73%, up from last week, with Sydney clearing at 75%. Then moving on to Victoria clearing at just under 68% for this weekend, and Melbourne clearing at 69.5%. South Australia is still the strongest clearance rate in the country, clearing at 75.4%, with Adelaide clearing at 74.5%. So New South Wales definitely catching up to take the throne away from South Australia. Then moving on to Queensland, a little bit softer auction clearance for this weekend. The Queensland clearance rate at 58.7%, with Brisbane clearing at 62.5%. Western Australia, a little bit of an improvement from last week, so clearing at 50%, and Perth up from last week, clearing at 40%. Right, moving on to this week's topic. So what makes positive a property investment a positive cash flow, and what makes it a negative cash flow property? So we look at the net of your investment. So if we take the net rental or the gross rental, and we subtract the interest and principal payments that you have on your bond, and you subtract the outgoings such as strata, council rates, taxes, etc., then if the net result of subtracting all those outgoings is positive, then it's classified as a positive cash flow positive property. There's obviously a variance on how we define cash flow positive properties. In some cases, we exclude the principal payments of the loan, and if that results in net outflow with excluding principals is positive, then it's classified as a cash flow positive property. Then obviously cash flow negative is if you subtract all those and it's a negative cash flow property. But what makes a property, what are the factors that determine whether it's positive or negative? And a lot of it's got to do with the risk in the actual property. So if you take an example, a blue chip investment property you'll find in Sydney or in Melbourne, for example, they typically tend to be cash flow negative, and it's because the property prices are so much more expensive. So, and this is on a relative basis when compared to the amount of rent that you're attracting. So you'll typically find in today's market, a lot more properties are becoming cash flow negative, and that's because your interest rates are sitting at such a high level. And in particular, in Sydney and Melbourne. Even though we've had an uptick in demand for rental cash flows, it obviously hasn't caught up with the level of property prices. So if we take your rental per week, you multiply it by 52 and you divide it by the purchase price of your property, that'll give you your yield. If that yield is below 6%, it means that you are definitely in cash flow negative territory because your debt is around 6%. And if your yield on your rentals are lower than 6%, it's definitely a cash flow negative property. And that's excluding the outgoings such as strata, council rate, etc. That's assuming it's a unit. Obviously, you won't have strata if it's a home, but you also have to include stuff like land tax and all that. So it's all the expenses going out that you include in it. So nowadays, because of the interest rate environment we're in, you typically need to have a yield, a gross yield in your investment property of between, I'd say, around 9 to 11% to have a cash flow positive property. There are regions in Australia where you do get cash flow positive properties, and they tend to be more regional, rural areas. And that's because the property prices are low, there's less demand there because there's less population, there's people seeking employment there, and as a result, the property prices are low. However, in those areas, people tend to want to rent. So the renters are high in comparison to the price of property. That makes it cash flow positive. So what are the pros and cons of choosing between a positive and negative cash flow property? So let's look at them in isolation. So the pros of a positive cash flow property is that you've got inherently lower risk because of having a cash flow positive. So you're able to easily meet your commitments every month on holding your holding costs on their property, such as the debt payments and the outgoings. But there is a reason why that property has a positive cash flow. So in financial markets, the more risk you take, the higher the yield you demand for taking that risk. So when I said it's less risk in the sense of your cash flow management, you're taking a higher risk in terms of the property not being in as much demand as a blue chip property. And for that, you demand a higher yield. And that's typically why regional areas, rural areas have higher yields, to embrace that risk that investors take and make it more attractive. Now, when I say it's more risk, it's arguably that, investing in property in regional areas is not as risky as investing in the stock market because you don't have the mark-to-market fluctuation. So it's all relative. So it's more risk when compared to a blue chip property. But now let's go on to the pros and cons of a negative cash flow property. Now, here the risk is from a cash flow point of view on a negative cash flow property, and that's because the property is not able to wash its face. So every month, because there's a shortfall in the amount of payments you owe on the bank, on the outgoings, for example, you have to chip in, so to speak, and with more of your own equity. So it costs you more money every month to be able to keep the property alive, so that you don't falter on your payments. So from a cash flow point of view, it's riskier. You have to be able to plan to be able to contribute to your mortgage payments in that instance, because the property doesn't support itself. The pros are that these properties tend to be in blue chip areas such as Sydney, Melbourne, city centres, for example, Brisbane, and they're in more demand because those city centres attract a lot more population that are wealthier and are seeking employment in those areas, and the demand for those properties are higher. So your growth on a negative property, in theory, should outstrip those of a positive property because of demand, an inherent demand for that property in the system. So, pros and cons in a nutshell: positive cash flow property, you're able to have some capital at the end of the month, not have to chip in and contribute. So there's less strain in terms of having to chip in with more equity. However, you sacrifice growth. In a negative growth property, you have to contribute more in terms of cash flow every month. You have to chip in to your mortgage, for example. However, in theory, you'll get a lot more acceleration in growth. So how does this fit into a portfolio dynamic? I believe it's important to have a combination of both. You need the negative cash flow property because you want to have that growth dynamic in your portfolio. So you have a component that can shoot the lights out, so to speak. And then you want to have the positive cash flow element to keep the cash flow dynamics of your property portfolio healthy, so that the contributions every month, you're able to sustain it because of that positive cash flow. So having a mix between the two is good. So you can have a growth dynamic and then a cash flow dynamic to support your property portfolio. Where to start? It's typically up to the risk appetite of the investor, whether you start with a negative cash flow property or positive cash flow property. If you've got a secure job and you're able to support a negative cash flow property and are seeking that high growth dynamic, then invest in a blue chip property in Sydney or Melbourne, for example, one of the city centers, and you'll see better growth dynamics over the next couple of years. However, if cash flow is a little bit of a problem, then I would recommend going for the cash flow positive property, because you still get some element of growth, but then at the end of the month, you have less worry in having to contribute extra. But over time, I like to see a healthy portfolio of combining both of those type of strategies. Obviously, there's others as well that you can include into that, but the topic's obviously just on negative and positive cash flows properties. And there's obviously a way to improve cash flow dynamics in those properties as well. So, for example, if you've got a blue chip property, doing renovations can increase the yield and the attractiveness for renters in that property and improve the cash flow of that negative cash flow property. So there's obviously ways to massage these strategies. I hope this was valuable, and we look forward to seeing you on the next one.
Thank you for joining me on this episode of the Valmika Property Investing Podcast. I hope you found our discussion insightful and empowering. If you're interested in finding out more about our services at Valmika Buyers Agency, visit our website at valmikaproperty.com. There you'll discover how we can assist you in making informed decisions and achieving your property goals. See you on the next episode.